Now, let's try to see some other key ratios which are used in the industry or companies. So one of the key ratio is EBITDA, which is, or not the ratio, I can say a technical financial term, which is EBITDA, like earning before interest, tax, depreciation and amortization. People call it as EBITDA or EBITDA, whatever you call it. Now, there are two different ways we can calculate it. It simply shows one way as top down approach and another is bottoms up approach. The approaches are very simple and similar, there is no much difference. So what this EBITDA simply shows that what overall earnings you are doing from your business. So this business should only reflect the earnings from your operations. So basically what does this consist of? This takes into account what is your sales, and then you reduce the cost of goods sold from it, that gives you gross profit. Then after that you reduce only operating expenses from it, because you want to know what are your actual earnings from business operations. Why? Because depreciation and amortization happens in the P&L, but these are non-cash expenses and these are due to you have taken the assets. This is not due to your routine operations. So people and the management wants to know what is their operating earnings, which gets to know through EBITDA. Now let's see our P&L and try to get a sense for our EBITDA number here. So this is our PNL here. Now within our PNL, if we go and see what is our sales, it was $400,000. Then our cost of goods sold was $250,000. Gross profit was 150. Our operating expense is $60 and our interest expense is $10. Now here in our example there is no depreciation, but if there would have been depreciation then the treatment would be different. But right now if someone asks you what is your EBITDA, so you can say my gross profit is $150 and my operating expense is $60. So effectively $90 will be my EBITDA. And if someone also says that if there is some depreciation within it, then this number may change, but right now I am assuming there is no depreciation or amortization, so this $90 becomes your EBITDA. So if we go below here to our EBITDA, which is this one, so you can simply see that our EBITDA is $90. Now in the bottoms up approach, what you can do, you can just do the reverse calculation from your P&L, where you can take your net income, add income tax expenses, add interest expenses, add depreciation and amortization to get your EBITDA. In your P&L, if you go and do the reverse calculation, ultimately you will reach to this $90. So if we go again there and try to see how does this work and how can we calculate it. So let's go and see here that our overall net income was $56. Now income tax, if we add within it, so that will become our $80 net income before tax, and if we add the interest expenses here as well, this will give us the amount of $90 for us. So this $90 again just came from here in a reverse way, we call it as bottoms up, or we call here from the top down. So more or less there is no much technicalities in it. This was a simple ratio, but in across industries, across companies, everyone uses it because they wants to know what are their operational income, because other depreciation and other items keeps on happening at different point of time, right? So if we see why the EBITDA is used, so EBITDA is used to check the core profitability. It shows how much profit a company makes from its main operations before financing, because we don't consider the interest expenses here, before government cost, taxes, and before any depreciation and amortization. So this is the real earnings people focus on. Then it helps for the cash flow proxy as well, since depreciation and amortization are non-cash expenses. EBITDA gives a closer picture to cash generated by operations, because this will simply show very near to cash. Comparability can be done, helps companies to compare across industries and geographies. And finally, this is a valuation tool. Investors often use EBITDA to value companies. So valuation generally being done by enterprise value to EBITDA multiples, or there are some other valuation methods, but that is being used by investors. Now let's see some real world example where these are used. So if we see the Netflix, it uses EBITDA to show its operating profitability without the heavy depreciation cost of content and amortization. Because whenever Netflix create a cost, that creates the intangible asset for them, because they are creating some web series or movie, then that intangible assets can be used for a longer period of time, and that causes heavy depreciation and amortization. But Netflix wants to show their earnings from their routine operations, so they use this EBITDA ratio. In an investor presentation, Netflix highlights EBITDA margins to show scalability of streaming. They show this numbers. If we see the Airbnb, they report adjusted EBITDA to investors to strip out unusual items like COVID recovery, restructuring. Because what happens is, like, if due to COVID, EBITDA was showing very low. Why? Because no one was renting out these Airbnbs. If that situation was there, then people report adjusted EBITDA to show the realistic picture which will happen throughout the period after the COVID has gone. So some items are being adjusted here if the needed. This helps analyst evaluate its true operating performance. The Tesla company investor often look at EBITDA to understand Tesla's profitability before accounting of huge research and development spending and depreciation of gigafactories. So gigafactories are having huge depreciation and huge amortization. So they should not be considered while deciding upon the operating performance of the company. In the case of private equity and M&As, when buying and selling companies, EBITDA is often the best metric or the base metric to decide valuation, because it shows the normalized cash generated potential. So it shows the cash generation potential. So overall, this is a very critical ratio, not the ratio item which needs to be seen in the company's financials.